This is the Human Action Podcast with your hosts, Jeff Deist and Dr. Bob Murphy.
Welcome back, ladies and gentlemen, to another episode of the Human Action Podcast, joined, as always, by my co-host, Dr. Bob Murphy. How are you doing, Bob?
I'm doing all right, Jeff. How are you doing?
I can't complain. Our topic today...
And yet that's all we do on this show.
That's all we do. No. We offer realistic solutions.
That's right.
Causal realism is what you'll find, the Human Action Podcast. But our topic is U.S. debt, and particularly U.S. debt default. And we're going to make the case why that's not only an inevitable thing, but a good thing, a thing that ought to happen from an ethical perspective. And in part, Bob, this issue is raised... my summer intern, Connor Mortel, helped me with some data a week or so ago for an article we published called Rising Interest Rates May Blow Up the Federal Budget. And we'll link to that. And of course, that article lays out some scenarios under which just sort of historically average interest rates, which apply to future debt, not to existing U.S. Treasury debt, could force Congress to start spending over $1 trillion just in annual debt service very, very quickly. And if interest rates were to rise on future debt to, let's say, 5 or 6%, then service on that debt would quickly, very quickly become far and away the biggest single item in the congressional budget every year. So that's an unhappy scenario, but not necessarily an unlikely one. And a lot's been written about this, the idea of a U.S. debt default over the years. I went and found there's actually a brand new 2022 report by the U.S. House Budget Committee called The Consequences of Higher Interest Rates to the Federal Budget. We will link to that as well. But if you go through this, you can see very quickly by 2050, which a lot of our listening audience is going to be, is young and is going to be right in their prime in 2050, 30 years from now. Boy, oh boy, the CBO baseline in terms of forecasted future revenues and future interest rates and future debt, I mean, very quickly by 2050, we get up to several trillion dollars, maybe 7, 8, 10, 11 trillion dollars in annual debt service, and it rises to well over 50% of expected federal revenue in that same period. And what we're talking about, of course, is simply debt, which will increase as deficits go up. We're not talking about those off-balance sheet entitlement promises, which Uncle Sam has made to a lot of seniors in the form of Social Security and Medicare. Those obligations are completely separate from this. Those are many tens of trillions of dollars. But we're just talking about the actual operating debt, which Uncle Sam has amassed to date and will continue to amass with probably ever larger deficits. So, Bob, let's start with this idea of, is it even legal? Because the 14th Amendment brings that into question.
Right. So I think if you go and I've seen some people argue that, but that has to do with the debt shall not be the federal debt shall not be questioned, but then of saying the debt of the former Confederate states, is no longer binding. So to me, that wasn't upholding the debt issued by the United States Treasury as being now more sacrosanct than it was in 1860. I think all that was clarifying it. I mean, because if you think about it, it would be kind of a weird situation if some of the states broke apart and then they issued bonds and then they were conquered by force and brought back into the Union and so forth. And then the question is, are those debts of the same legal character as the ones that the U.S. Treasury issued, to fund the war between the states, let's say. And so to me, that's all that amendment was saying. It was not giving it's saying like, at this point now it would be unconstitutional to default on it. I think all it was saying is, don't let the fact that it's because some states broke away and issued their own debt and we're not honoring that. Don't let anybody question the legitimacy of, the debt that the functioning central government of the United States issued during the war. That's obviously I'm not a constitutional scholar, but that's the way I read that. So for people pointing to the 14th Amendment to show it would violate the Constitution to default on the debt. And I thought you right-wingers were all I don't think that's a good argument.
Well, interestingly, the Supreme Court appears to not really have touched this question. Hasn't come up. Congress, even when it comes up against these budget deadlines, always manages to pass a continuing resolution or whatever to keep the federal government functioning in the 11th hour. Now, real quickly, the language of Section 4 of the 14th Amendment reads in relevant part, the validity of the public debt of the United States, shall not be questioned. Now, again, as Bob mentions, this is coming out of the debts which were incurred prosecuting by the Union, prosecuting the Civil War, and also by canceling the debts of the southern states, the Confederate states. But when we talk about the validity shall not be questioned, well, when a debtor gets hauled into court over an unpaid debt, he or she is not questioning the validity of the debt necessarily. What they're saying, I don't have the ability to repay. So I don't think the language itself is expressly clear on this. Look, the federal government's probably going to pay its debts at least nominally for the foreseeable future. You can always inflate this. So I guess that's an interesting question. But whether it has to legally under the 14th Amendment, I would argue, is not established.
Just to give people more of an analogy there, that like you say, suppose some company, corporation has issued corporate bonds and it just has a few bad quarters and it just can't pay it and it defaults. It's the corporation, they would not be saying to the bondholders, you know what, those debts you own, they're not valid anymore. They, like you say, they would just say, we can't pay you. Let's, give it a haircut. Let's do a restructuring or whatever it is. But they wouldn't be saying it's not valid. It's just they're saying we can't pay. So likewise here, I think when you go and read that 14th Amendment in its entirety, it's just establishing we're not the Confederate debts. Nobody's paying on that. Forget it. It's if you lent money to that government, that's your fault. Whereas we're not going to question the validity. It's not saying that to now default on it would be unconstitutional. I mean, they're supposed to pay it. Like, no one's doubting that the government said, if you lend us money, we're going to pay you back. The issue is just, well, what if there's a crunch and they can't, or there's other priorities too? That's the issue.
Well, and of course, the idea that debt doesn't matter, deficits don't matter, a lot of people think this. Dick Cheney thinks this. Stephanie Kelton of MMT fame thinks this. Paul Krugman thinks this. So, it's reasonable for people to expect a sovereign, especially one as powerful as Uncle Sam, to be able to pay its debts, and it can always, find ways to do so. But a lot of people over the years have argued in favor of default. People were arguing for this way back in the 80s and 90s when the U.S. debt was 3, 5, 7 trillion, not 30 like it is today. So on the side of pro-default, let me just mention a few names. John Tamny, who is then at Cato, now at Real Clear Markets. Jeffrey Rogers Hummel argued in favor of. James Buchanan, the famous father of public choice theory, in 1987 wrote an article called The Ethics of Debt Default. James Grant of Grant's Interest Rate Observer has come out in favor of default. And of course, perhaps for our purposes, most infamously, in 1992, Murray Rothbard wrote an article in Chronicles magazine titled Repudiating the National Debt. And I want to talk about that briefly, Bob. He makes this great distinction between so-called public and private debt and why the contractual rules, which ought to apply rigidly to private debt between two private parties, ought not to apply to public debt. So let's talk about that.
Sure. So, Rothbard just first establishes somebody in the private sector lends money to a borrower, and then the borrower says, I'm going to repay you the principal plus interest, let's say in a year's time. A year goes by, and then if the borrower does not repay, Rothbard argues, he doesn't elaborate too much, but I get the sense that, like, suppose the borrower actually had the money and just decides not to pay, that Rothbard argues, in a sense, it's like he stole money, from the creditor. At that point, that money rightfully belongs back to the creditor plus the interest. And if the borrower doesn't give it back to him, there's a sense in which he's hanging on to the legitimate property of the lender. And so Rothbard says that's clear cut. So if you had the ability to repay your debt and chose not to, then Rothbard says clearly you're violating property rights, and there's a moral presumption against that's not an ethical thing to do, to the extent that you think that you should respect property rights. But then when it comes to government debt, it's entirely different. That people voluntarily lend money to the Treasury, but everybody knows that how is the Treasury going to get that money back? It's not because they're running a profit-seeking business and they're providing valuable goods and services to customers. It's because down the road they're going to use coercive taxation to take that money, involuntarily from taxpayers and hand it over to the borrowers. And so Rothbard is saying that the coercion is introduced at the tail end of the process when the debt is repaid. And so he's saying that is a completely different thing, economically, ethically. And so just because we have this presumption that, you ought to pay your debts, does not carry over into say, oh, the responsible fiscal thing to do is for the government to honor its debts. And I noticed you've probably seen this too, Jeff, that for some reason, even among pretty hard-nosed right-wingers who are very skeptical of government, they say, oh, let's slash the Department of Education, let's slash this, let's slash that. One of the last remaining bastions would be, oh, of course we couldn't fall behind on payments, on the debt. That's like considered to be like one of the last things you would ever go back on. And yet, as Rothbard's pointing out, that no, it's not clear at all why you would honor that it's you're taking money from people against their will to pay off what previous governments borrowed.
Yeah, it's not clear. And Rothbard argues, he says, look, you didn't borrow the funds, you didn't spend the funds, you have no more obligation to repay the funds. And so both parties, to what he calls an immoral contract, both the borrowing and the lending, the public loaning funds to the government, they understand that the politicians themselves, Congress itself, is not going to pay this money back. The future taxpayers are. So that makes us a completely different than a private debt. So I think that's an interesting point to make. It is attacked by a lot of people, as you point out, a lot of conservative types. Bruce Bartlett comes to mind. He's written a lot about this in places like the New York Times. He's a conservative, turned out to be a big never-Trumper. Actually worked for Ron Paul back in the day. In the late 1970s, it was his first job, his first real job, his first job on Capitol Hill. And then he worked for the Reagan administration during the 80s and basically became a supply-sider. He wrote an article back in about 2013 in the New York Times saying, well, for these hardliners, debt default is the goal. These crazy conservatives just want to default on the debt. And so, as an aside, Bruce Bartlett is just an inveterate hater of Southerners and all things Southern. And he has a very facile, childish, kindergarten view of the Civil War. And as a result, he's still beating this dead horse. He's still saying, after the Civil War, the Confederate debt was repudiated and not permitted to be repaid by the states. The Southerners have always resented this. Well, imagine that. They lost a war and then no one got paid. Yeah, they resented that. And then he says there's still many in the South where the Republican Party is now based. That's kind of true. Whose hostility to the national debt traces back to those days. Well, okay. I guess I'm a Southerner now by virtue of relocation. So I have hostility. I can't trace it back to those days, but hey, whatever. This whole idea that, as Rothbard points out, that we should, cut some things but never consider touching a hair on the head of the national debt because that's some sort of sacred promise. It's just ridiculous. We'll get to this, but look, the idea that the lender to the U.S. federal government, which is the most crazed spendthrift in the history of the world, should do so knowing that they're just going to get paid back A-OK, strikes me as a little crazy. What do you know or what do you think of the literature on default by, some of these aforementioned names?
So it's interesting. A lot of the people you cited, they just talk about like the ethics of it and so on, or and they will talk about like the economic consequences. And I know we should dwell on this, but it's a kind of thing where I think a lot of it is people just tell us how awful it would be, but since it hasn't happened recently, like we're not sure how awful it would be, and also Jeffrey Rogers Hummel, he in his article he goes through, it was I think in the 1840s, showing how several states, so it wasn't the federal government, but it was state level governments, either explicitly repudiated their debt outright. I think 4 states did that. 4 other ones like partially defaulted. They didn't just completely write it off, but they partially defaulted. And some other states got into serious trouble because there was a financial panic and so on. And it was partly debts accrued during the War of 1812. And so, and his point was what ended up happening. It wasn't as if there was just unending misery and it was a horrible experience. It was the states then, a lot of them adopted constitutional amendments saying you can't run budget deficits anymore. And the primary thing, though, is what would happen is lenders would all of a sudden realize, it's now fast forward, and let's say if the U.S. government partially defaulted, they would break the spell of the U.S. Treasuries being the global safe asset. Then people would realize, oh no, it is possible for them to fall behind. and then people would be more reluctant to lend their money to the federal government. So especially if you believe in the sort of economics that Austrians do, other things equal, if a lot of people now are less willing to lend resources to the U.S. federal government, that's a good thing. Morally and ethically, but I'm saying even economically, that means fewer resources now are going to end up under the control of the U.S. political system. So that's actually a good thing. And also, too, what's funny is a lot of right-wingers, they're always bringing a balanced budget amendment. It was probably a bigger deal, a few decades ago. I know when I was growing up, that was always a big thing they'd bring up and say, if only we had the votes to push through a balanced budget amendment.
Yeah.
Every time the debt ceiling is an issue, it's, well, we're really serious. Well, we're going to raise it to avoid a crisis. But, if this were to happen and then people were very reluctant to lend to the U.S. government, accepted perhaps, high interest rates, that would impose the discipline. They would have to just run balanced budgets if they weren't allowed to raise funds from outside lenders anymore. So it's, yes, there would be a crisis in the short term, but long run, this would impose fiscal discipline, and it's not clear why that would be such a bad thing.
Well, one of the responses I received to my article was that a reminder, look, the federal government has nothing. Everything it has, it removes from the private economy. So the idea whether that's debt or whether that's via taxation is not really the point here. The point is that what is the federal government doing and what does that cost the economy overall? So this idea that of the 30 trillion-ish, thereabouts, which is owed in Treasury debt, only about 23 of it is actually interest-bearing to the public. So the other 7-ish or so are intra-agency, including the Fed, owned by the Social Security Trust Fund. The Federal Reserve owns somewhere in the neighborhood of $6 trillion in U.S. Treasuries out of its currently $9 trillion total balance sheet. So there's some other things there like mortgage-backed securities. What do you think of this idea, Bob? Ron Paul actually ran on this when he ran for president twice. He said, look, we should just cancel that part that agencies hold or that the Fed hold. Right there, we could go from 30 to 23 trillion roughly in debt overnight. Do you agree with that? Would that have ramifications that I'm not understanding?
It's so certainly, as an accounting move, it would work. It's funny. That's the kind of thing where everyone is saying, "Oh my gosh, that'd be inconceivable. You couldn't do that." And it's not. Again, it's not obvious to me that it would have huge ramifications. So I certainly think it's an idea worth exploring. Beyond that, too, I was just looking up. I had back in 2011, again, was when one of those debt ceiling issues was in the news again. And I just did a quick back of the envelope thing, and I came up with $1.6 trillion of federal government assets that were quite liquid, like oil in the SPR thing. And they could just transfer it to private ownership. It's not that the oil would have to get dumped on the market. There's a lot of offshore things that are off limits, a lot of federal lands, all sorts of stuff that the federal government owns, a lot of real estate. So yes, it's the federal government does have the ability. It could use, like you say, certain accounting maneuvers for some of the intra-government debt and other assets that are on its books. There's a lot of leeway that it could use to partially absorb some of this outstanding debt held by the public.
Well, let's talk about that public. Of the 23 or so held, apart from the U.S. government and the Fed, so about 26% of that is held by foreign governments or foreign central banks. So that's interesting. About 12% of it is owned by mutual funds. That's probably how most of our listeners might own treasuries, or in their pension funds, their 401k or company pension. State and local governments own about another 5%. Depository banks own about 5%. So there's a variety of ways. Not too many people, unlike my grandfather, actually go and buy treasuries directly from a broker or something, and there used to actually be paper that you owned that recognized your U.S. Treasury holding. So there's a lot of people who hold Treasury debt around the world and across the U.S. who would absolutely be harmed by some kind of default or some kind of haircut. I guess the question is, who should pay? I mean, what's the alternative? The alternative is inflating the debt away, more slowly or more rapidly, but either way, the same effect. on effectively monetizing this debt while we rack up more and more of it. The actual lenders themselves, and some of these are, old people who just have some money in in their pension fund, in their 401k. The actual lenders, including the BlackRocks and Vanguards of the world, could take a haircut. Or I guess the third alternative, which you just alluded to, is the federal government can start selling assets. But there's a real question, Bob, as to what's the value, the net present value of all the federal government's holdings, including and especially land out west. Kind of hard to determine.
Right, exactly. And so, yeah, of those things, let me just isolate, though, because I think, like when right-wingers say, the way down on the chopping block would be defaulting on the debt, like that's sacrosanct, that's commitments that they made. I think what they have in mind is, instead of like starting up a new welfare program or some new thing to give money to people that previously weren't expecting to get anything, and this is just some new program, you got to pay back the people who already lent money to the government. And, we could discuss that one way or the other, and that might be fine. But a different example would be if push comes to shove and the government has to reduce the promised benefits to Social Security recipients or partially default on outstanding Treasury bonds, then to me that's clearly an ethical case in favor of you would default on the Treasury bonds, even though for most people they would say, no, that's crazy. I mean, no one promised the Social Security people like that. That was just guesstimates made. It wasn't like it was a contract they had. But because again, the crucial difference is workers had money taken out of their paycheck against their will, with the promise, and you're going to get paid back, and the rate of return they're earning is typically lower than they would have gotten, through private vehicles. And so if then they're getting less than they were supposed to get, what they were told at the outset, to me, that's a much worse default, even if it's not legally construed as such, than for people who voluntarily lend money. Like, in other words, you don't have to participate in lending money and buying treasuries, whereas if you're in the United States, you have no choice but to contribute to the Social Security program, for example. So that's an example of a kind of thing where, again, if a choice has to be made, it's clear to me ethically what the right thing to do would be.
Do you agree that it's unlikely the U.S. federal government will be able to service its debts and pay entitlements based on projected future tax revenues in any meaningful way? I mean, given this fiscal gap between entitlement promises and likely revenues, which Lawrence Kotlikoff and other economists have talked about. I mean, is this something where some form of default is inevitable? I think Paul Krugman would say no, but what would you say?
Well, I think it's absolutely inevitable. Again, they're going to decide what form it's going to take. And my guess is it would be some blending of the things we say, that they're going to, yes, officially cut Social Security benefits, at least in real terms. They're going to, extend the working age for Social Security, things like that, and then inflate away the real value of the outstanding Treasury debt. And to give people some ideas, like when I was growing up, the looming entitlement crisis was always 20, 30 years in the future. And people saying, well, that's going to really hit. It already, after 2008, was the case that worker, payroll contributions, again, that euphemism contribution, were not enough to cover outgoing benefit payments to recipients. All right, that was already the case. So it still had not eroded away the value of the so-called Social Security Trust Fund. If you want to keep those programs distinct and say the program had built up as, again, it was just Uncle Sam borrowing with his left hand, with the right hand was holding, kind of thing. But so in terms of the accounting of the Social Security books, they already were having a cash flow deficit, after the financial crisis. And so they were just whittling away, at the trust. Well, it was like the earnings of the trust fund were enough to offset it, but I think they even started cutting into that too. And so it's just a matter of now they just have a date at which even the trust fund's exhausted, and then they got to go to the general, revenue fund in order to cover a shortfall. So that's not too far away. So again, this is not some far-flung thing. I mean, this is stuff that's going to happen pretty soon. And again, like those CBO estimates that you talked about in the beginning, Jeff, for people who don't know, the CBO actually is like when Congress persons give them instructions, they can kind of like load the deck and say use these assumptions. But other than that, it's actually pretty straightforward. And I've even had people from the CBO contact me about an area where I kind of knew some of the details to just say, hey, are we doing this right? Do you agree with these subtleties? So they actually do try to be nonpartisan, believe it or not. But what they don't do in those projections is factor in, is there going to be another major recession? Like those projections you have in there just assume interest rates gradually return to, quote, normal historical levels. It's not building in anything that I think is quite realistic. Like between now and 2050, you don't think there's going to be another major economic crisis? I certainly do. So when you start baking that stuff in, you see that even those projections you talked about, Jeff, are very rosy. So are they going to be able to get to 2050 without some combination of letting CPI run a lot higher than people are thinking and cutting back on Social Security and Medicare and things like that? No, there's no way those numbers are going to add up.
Well, there's a couple of real problems in this country. One is the rapidly declining birth rate, and COVID accelerated that. And number two is the cohort of Americans over age 65 is set to double by 2050. So people are living longer. We're going to have all these people promised entitlements. So even though these entitlements are off the books in terms of the debt that we're talking about, if Uncle Sam's paying those, that impacts Congress's ability to also budget for debt service. And again, going back to those CBO numbers, it wouldn't be crazy for the average interest rate weighted on all that outstanding Treasury debt to grow into 3, 4, 5, 6, 7% over the coming decades. And as a matter of fact, it's back down below 3%, but recently the 10-year Treasury rate went up over 3%. So just at 3%, that's roughly double the average weighted interest rate that Congress is paying right now on all the older existing debt. So it's already going up. So that's all that's very scary. In other words, the projected future revenue versus the projected future outlays. Those numbers just don't add up. And if Paul Krugman or someone else says they do, they're counting on some kind of growth scenario, which I would argue is just catastrophically wrong. So
if I could just make one quick point on that too, Jeff, you're right. So those numbers, what CBO is talking about, public debt or debt held by the public and things like that, and as a ratio or fraction of GDP, that doesn't include the entitlements. But you're right, to the extent that over time we start getting a cash flow deficit from those entitlement programs, then that does impact the general budget too. And maybe one way to think about it is back in the day when Social Security was cash flow positive, when workers were putting in more than were going out in benefit checks every month, they were accumulating treasuries. So it was like there was this outside entity that was lending money to Uncle Sam, and now all of a sudden it's flipping and they're drawing down their debt. So just like as if China all of a sudden decided, you know what, we're going to just draw down our treasuries, and that would have a serious impact on Uncle Sam's finances. Likewise here, if the Social Security Administration all of a sudden, it used to be that it would be lending money, hundreds of billions of dollars every year in surplus to the government, low interest rate, and now it's all of a sudden flipping it and it's not rolling over its debt and it says, no, we need the principal and the interest right now because we're running a deficit over here. That does impact the day-to-day financing, even just looking at regular treasuries.
Yeah, and if you'll recall, Bill Clinton used to tout the fact that he had balanced the budget, but a lot of people argued that was only with this accounting trick, essentially, of what's supposed to be a lockbox. Remember Al Gore? Locked away Social Security Trust Fund, lending its overage to the operating budget of Congress. So if there's not going to be enough tax revenue to pay for all this, we get back to this idea of federal assets. And if the U.S. federal government owns land, particularly out west, and a lot of that land has mineral and oil rights to it, gee whiz, if Uncle Sam has, let's say, $100 trillion in holdings, then $30 trillion in debt is pretty manageable all of a sudden. If you applied that ratio to an individual, you'd say, well, that's fine. It's okay for a guy worth $10 million to owe $3, right? So the question is, how would we ever go about assessing or valuing that? There's an organization called the Institute for Energy Research, IER. They're pretty famous. And a long time ago, about 10 years ago, they went and took a look at all of the fossil fuels above and below the ground on federal land, and they came up with this crazy idea that there's 1,000 years worth of fossil fuels, and that are worth $150 trillion. So it'd be even more than the $100 trillion. I'm saying $150 trillion. The Cato Institute actually went and looked at that and said, well, first of all, we got to discount that. What does 1,000 years worth of energy mean? I mean, 100 years from now, we don't even know what oil or natural gas or any of those things might mean for energy in the economy. We can't just assume that the same types of energy will continue to drive everything. So the Cato study said it would take some 2,000 years to unload all this. And so, discounting for the future, Cato came away with a discounted present value of all these fossil fuels, again, above and below the ground on federal land, of under $4 trillion, which wouldn't help us very much, adding $4 trillion. So I guess, is there ever a scenario where the federal government would seriously sell assets and give up land? I mean, that seems to me to be the possible solution to this terrible conundrum.
I agree with you, Jeff, that that would be one way to get out of this without serious pain. By the way, just in interest of disclosure, I used to be an economist for the Institute for Energy Research, but I was not directly involved with that particular study, so I don't know.
How much were you paid, Bob? Come on. Look. What were you paid to say?
Less than 150 trillion. Yeah.
Less than 150 trillion?
So yeah, I do remember though that was an issue of, because it's the kind of thing where oil deposits, under the ground, and then having to bring them to the surface and stuff, so they shouldn't be valued at a full barrel of oil, but you got to make assumptions about, extraction costs and things. Part of the issue too is we just don't know. I think the Trump administration did allow for some exploration and things, not giving the rights to extract it, but just to allow private companies to go out and look and see, what's off the Atlantic coast and things like that. Whereas earlier, like literally companies weren't even allowed to look, so we didn't even know. So there's a lot there, but again, it's a lot of these things are projections. You wouldn't really know until you allowed private companies to go in and start developing them. And
again, they're all based on static technologies today. Look at what fracking has opened up in the Bakken region.
Right.
We now have something like 40% more shale oil than we ever imagined we have. So we don't know what technology would allow us to extract in the future. So it's hard to say, but it does.
Yeah. To come back to your question, though, it's the government selling that stuff up, but is that realistic? I mean, it's sort of like saying, well, what's the way out of our crisis is if the federal government would just relinquish its powers and give power back to states or individuals, that would solve a lot of issues. But I don't think they're going to just do that. Like, there's a reason, that they have that power, and likewise, I think there's a reason that they like maintaining control of all that property.
Well, I thought we might talk about what default might look like, and I wanted to bring up an interesting scenario because it's just so hard to conceptualize. Because the whole world is not only awash in dollars as the world's reserve currency, but again, all these foreign governments and central banks are awash in treasuries. So it's very, very complex to understand how it could even look and who would get hurt and who would come out ahead and this and that. So if we shrink this conceptually a little bit and just look at Greece. So back in 2015, coming out of the financial crisis, Greece had the Greek government had an actual outright default of about $1.7 billion on its bond debt, which it owed at that time to the IMF. So the IMF is not the same as a bunch of banks and individuals owning your sovereign debt. The way that came about was a few years earlier. They had needed to get a loan from the IMF. So the IMF basically assumed a lot of their indebtedness so that they could keep operating. But interestingly, in 2011, a lot of the private banks, which held Greek debt, did indeed take a 50% haircut. And there was some sort of some sort of judicial process behind that. I mean, that's how you would expect this to unfold. There would be creditors claiming that they were being paid in, let's say, depreciating dollars and make a claim against the debtor. And that would go into some sort of bankruptcy or insolvency proceeding, and there would have to be a declaration coming out of that as to whether a haircut was in fact authorized by the court. What's interesting here is that if we look at Greece in microcosm, there's a similarity to the U.S. in that once Greece and other Eurozone countries joined the euro, they could no longer control their own currency, but at the same time, they were still able and are still today able to issue their own individual sovereign debt. So their governments are still issuing debt, even though they don't control the currency. Here in the United States, individual states can, of course, issue debt. It becomes increasingly difficult for states like California, but nonetheless they can. But yet the dollar is controlled by the Fed. So if we look at Greece anyway, there's actually a real-world example on sovereign debt, not commercial bank debt like the situation in Iceland, for example, in 2008, but on sovereign government debt, where actual holders of that debt, in the form of commercial banks especially, took a 50% haircut. And so, I think maybe that's totally inapplicable to this huge gargantuan U.S. debt, but it shows you how it might happen.
Yeah, I think that is a good case study. And I just want to remind people, the issue is not, is there going to be turmoil or economic hardship? The issue is on whose shoulders will it fall, right? So it's not as, these people are owed money, and if the government didn't pay them, that would be painful to them, right? They thought this money was coming in and now they don't have it. Well, likewise, if all of a sudden, because of the budget shortfall, we have to go hike taxes over here, we got to impose a temporary surcharge on, a VAT or something in order to raise the money to pay this extra thing. Mm-hmm. I mean, that's consumers now would be out money that they thought they were going to have, and it's harmful to them. So again, it's not an issue of where is it, or are we going to impose pain or not? If the scenario we're discussing is right now, the incoming tax receipts are not enough in order to fund all these programs and the growing interest on the debt, that something has to give, and the question is just what is it going to be? So I think you're right, Jeff. That, my guess is that they would not simply say, we're going to all federal outstanding Treasury debt's canceled. They wouldn't just say that. My guess is that in practice, like I said, I think they're going to do a combination of things. They would let inflation, quote, run hot for a while, and that in a sense might help a little bit in terms of allowing for incoming tax receipts to be higher, measured in dollar terms, and that would make it easier to pay off the outstanding bonds. So the bondholders effectively would be getting paid in weaker dollars than they thought when they originally lent the money, unless, we're talking about tips, ones. So that's one thing they could do. And then, they could, if the situation's bad, just announce an across-the-board haircut. That's one way they could easily shave off 10% or whatever the number needs to be.
Well, I'm all for that. And if you own Treasury bonds, you shouldn't. You should stop loaning this maniacal, criminal, murderous U.S. government money, especially at less than 3%, folks. I mean, Bob, is there ever a scenario where people won't buy Treasury debt because Congress's fiscal house is so disordered, or because inflation is running so high, where people just won't buy Treasury debt, whoever those people or institutions might be, at anything less than junk bond rates? Is that conceivable scenario?
I think it's conceivable. I think we're moving towards that the interest rates are going to have to rise, especially, it's not just you and me, like I say, other people, analysts are looking at this and the numbers just don't add up. For a while, it did look like the normal rules didn't apply to the U.S. government and the Federal Reserve. Mm-hmm. After 2008, and I was guilty of this. I was very concerned about QE, and then it looked for a few years as if the Federal Reserve pumping in trillions of dollars in new base money doesn't have any effect. But now we're seeing that, of course, it does. And again, the perverseness of what happened is because interest rates were so low for various reasons the last decade, the federal government has run up an enormous debt. And now as interest rates just, not that they have to spike, it doesn't have to be like 1979, 1980 scenario. They just have to go back halfway to where they were before 2008, and we're going to have serious trouble. So, this is the situation we're in right now. And there's what they're going to do in practice, I think, is across the board, all sorts of things. And if they do a partial haircut, not only is that, I think the critics are wrong for saying how catastrophic that will be. I don't think so. I think as it approaches, markets will start pricing that in, and that will make interest rates rise. So it sort of like cancels it out, that new yields will rise as people start to anticipate the possibility of a default, just like with a regular borrower. And so then when the haircut happens, that might partially just be, well, people already built that into the assumptions. So I think that you'll see a situation like that as well. So it won't be as unexpected and catastrophic. They're not just going to do it next Thursday.
Well, but if the fiscal numbers get too ugly, and people pay a lot more attention to the fiscal side of things than the monetary side of things, won't it be tempting for the Fed to just buy a lot more Treasury debt so the Congress can keep running huge deficits, issuing debt for the moment still at relatively low interest rates, and have the Fed just snap that up? Because right now, again, there's about $6 trillion out of that $30 trillion in Treasury debt sitting on the Fed's balance sheet. Wouldn't it be attractive to just say, well, who cares if the Fed's balance sheet swells to 30 trillion or 50 trillion or 100 trillion because that's just a bunch of treasuries? I mean, is that implicit backstop, which the Fed has proved that they're ready and willing to act as that backstop when there's a so-called financial crisis, that monetary policy can clean up the mess? I mean, do you foresee that happening as on the fiscal side, the debt is growing precipitously?
So sure. So that's the basic MMT argument, is to say, why are we having this conversation, this discussion, as if the federal government is just like a big corporation that has to issue bonds, and what if we can't pay for it? They have a printing press. Come on, folks. And they're not completely naive, because then, of course, the obvious response from an Austrian libertarian type perspective is to say, well, if you just monetize the debt, that's just pushing the problem over in a different sector. And so now, instead of taxpayers having to fund it, it's dollar holders, and that's broad, meaning like assets denominated in dollars, not just literal currency, that by prices being higher than they otherwise would have been measured in dollars, you have less wealth, real wealth, than you otherwise would have. And so in a sense, it's just like taxing a different group of people to pay for the spending. And for a while, when, like I said, the huge QE programs came out, guys like me were very alarmed. And then it looked like, oh, no big deal. The MMT people were running victory laps. Now you don't hear as much from them because you start to see that. So they could certainly do that. But then again, the issue is just, okay, so that means you don't have to jack up taxes as much, but now price inflation is going to be worse than it otherwise would have been. And actually, just to circle back, that's one thing I should have mentioned when you asked earlier, what if they just canceled, what if the Treasury just said, we're not going to honor the treasuries that the Fed is holding. One issue with that is if the Fed, in order to arrest price inflation, had wanted to sell off its assets to suck money out of the system, if those treasuries were canceled, they wouldn't be able to do that. So that is one possible issue, that if there was no need for deflation, then it wouldn't be an issue in terms of the accounting, but it would mean the Fed would be unable to use that technique to try to undo the QE. So there is that problem. And that's what happens too with the problem with the MMT solution. If the Fed just says, oh, don't worry about it, you don't need to raise taxes, we'll just monetize it, is then if inflation starts getting out of hand, and also if interest rates rise, then the value of those assets falls, and the Fed, even if it did try to undo the QE, if the value of the bond is lower because interest rates spiked, then it can't suck as much money out of the system as was created when it initially pumped it in. So you do get into weird situations where, and that's why it's an issue if the Fed is insolvent. People are talking about lately, it hasn't been marked to market yet, but there's a sense in which right now the Fed is insolvent because interest rates rose, it's sitting on a bunch of bonds, and so the value of its assets fell, and the Fed doesn't actually have that much equity. Who cares, right? But it is an issue if they did try to reverse that, if they don't have enough now to suck the money out of the system that they pumped in.
Well, and to be fair to the MMTers, they do recognize that there are resource constraints. They just don't recognize that there are money constraints. But it's a bit of a straw man, but I would propose as a counter argument to MMT to say not all sovereigns are equal. In other words, look what happened in Argentina in the late 90s. Look at what happened in Zimbabwe. Look what's happening today in Turkey. They all have printing presses. They're all sovereign. They can all tax their citizens in their national currency, but it's not working out so well for them. So maybe the U.S., with its military might and its reserve currency status, is a different kind of sovereign for whom these things might last a lot longer. But, I really question this, Bob. I question the idea that MMT is ascendant, because it seems to me that real world examples today are disproving it.
Right. And I don't want to mislead the viewers. The MMT people, certainly the sharp ones, Stephanie Kelly, they're aware of inflation. Like they understand that. And you're right. They're just saying, no, we're just saying that the issue is not, can we come up with the dollars to pay the bondholders? The issue is, do we have enough real resources? Will that cause an unacceptably high rate of consumer price inflation? Things like that. But what I'm saying is even though they acknowledge that, they do seem very glib often about, well, okay, but this really is, going to cause price inflation. And they're really, if you're funding programs, if the government's building more tanks because it ran the printing press, then those are real resources that went into those tanks that could have gone elsewhere. That I think, coupled with their view of how the money in banking works, the MMTers tend to have a pretty, I would say, crude view that there's all these untapped resources that the private sector is not utilizing, and we just need to open up the monetary spigots in order to get them into operation. And, as an Austrian, I don't think that's true. That I think, no, the private sector very quickly enough can mobilize resources, just let it work. And you're right, too, that the MMT people, they know about what happened in Zimbabwe, and you're right. They just say, oh, well, but the U.S. is a different kind of country because they have debts held by foreigners denominated in dollars, whereas the Zimbabweans, the exchange rate hurt them a lot. But again, that's because the U.S. has had a relatively good track record. If the U.S. followed the MMT advice, it would lose its special status. It would turn into a Venezuela if they kept listening to the MMTers.
Well, it's really a fascinating topic, scary topic. We are going to link to, my article from last week. We will link to the Congressional Budget Committee's report from May 5th, 2022, The Consequences of Higher Interest Rates to the Federal Budget. We will link to Murray Rothbard on this idea of repudiating debt. Bob, any last points you want to make on this?
Again, I would just, you brought up with the bankruptcy stuff, that do not assume that there's something magical about governments. They can get into financial trouble too. There are plenty of historical examples of major governments defaulting on debt. This isn't just, some abstract hypothetical thing that Rothbard dreamed up. This really does happen. And that's what we have bankruptcy law for, and David Stockman made that point, following the 2008 crisis. People just assumed that it was inconceivable that these big banks might have to go into bankruptcy. And he said, why? We're not creating more assets by bailing them out. We're just shifting, where the burden falls. So likewise here, you're not making society wealthier by somehow avoiding default at all costs. You're just shifting where that pain falls.
Yeah, absolutely. Look at Lehman Brothers. They were around since the Civil War, and they're not with us anymore. Thanks so much, Bob. I really appreciate you joining the show as always. And ladies and gentlemen, have a great weekend.
Check back next week for a new episode of the Human Action Podcast. And in the meantime, you can find more content like this at Mises.org.